Training video 30, spotting a strong bullish golden cross. This is Matt Shaw, Chief Analyst, Knightsbridge Trading Academy. Now, just coming from the bearish cross, whereby the short-term moving average crosses down below the longer-term moving average, the golden cross is exactly the opposite. Pretty self-explanatory. Now, this is an example from by where the euro dollar, going back late last year, exactly a year ago, crossed down through its moving averages. We had the bearish death cross, and it sold off again, made a lower high, sold off, carried on, and then bottomed out at 103.80 or thereabouts. And then it started to rally. It started to rally into January, and around the time Trump came to power in the US, and topped out here. Now, interestingly enough, the shorter-term moving average crossed over the medium-term moving averages. Just about, but again, not enough. It crossed it, but it didn't cross the longer term. We always needed to cross, what I always wanted to do, is cross the two moving averages and not just the medium. Now, it can just cross the longer-term one. It can just cross the very long-term by itself, but I like to have it to cross the two. Now in this case, it only just barely scratched the first medium term one, and this just, as you can see, as it topped out, it just edged back lower, then again regrouped itself, made a higher low, higher from this level, from where it started out, but it's still a low because it just sold off back to this level, but it's at a higher region than here. So it made a higher low, settled for a few days, and for a few weeks actually, and into March it then began another rally. But then again, look here, again, it only crossed the medium term, only just glanced the longer term one, and then the market failed. It was a false breakout. This was a false breakout. It only touched, it didn't cross, and didn't cross it by any margin, never mind by a specific margin, which is what we want to see. It glanced it, came back off, and regrouped itself again. But look what happened the second time. It gapped higher. It really wanted to take off this time. It gapped higher, and again, look what happened here. The shorter term moving average in April crossed over the both of them, and more importantly the longer term yellow one, and carried on higher from this gap, and then went on from there. Went on all up to 114, 150. Currently where it's trading now, the levels of 117 actually, but then from here it actually made a good 500-600 pips. Now your entry point, we go through this in more detail on our courses, but again, it was around about this level here, this level, once it actually broke away from this moving average by a certain amount and then carried on that direction. As you can see, it just came back slightly here from this little high. Basically not much at all really, considering it gapped already 200 pips, came back about 70 pips, which is still 130, 140 higher than here, and then carried on higher, didn't look back. So you could have just continuously raised your stops 20 pips, 30 pips, 40 pips, 50 pips, and followed the price up through. But your entry, yes, you could have got in here, you could have got in right at the bottom. I mean, hindsight is a wonderful thing. You could have got in at 104, 103.80, excellent, but there was no confirmation this wasn't going to sell off even more from the previous bearish death cross. So how are you supposed to know? You wait for these confirmations, and specifically the bullish golden cross is a great one to wait for, to confirm that a downtrend has come to an end, and that's it. So this was its final entry here, not here, not here, not here, not here, not here. Here was its perfect entry on this level, above 108. Yes, 400 pips off the low, but still it went on to rally another 500-600 pips. Okay. Now let's look at gold. Lastly, I am trading gold at the moment. I'm looking at a few gold trades, so I want to look at gold for this. Now, looking back late last year, again, perfect example of the bullish cross. Now, here you can see it bottomed out again, coming down from a sell-off the market bottomed out. Again, no confirmation that it's going to rally or sell off even more from here. How are you supposed to know? You wait for that pullback, you still wait. Again, short-term moving average, it crosses that, the price, that doesn't mean anything. Well, it means something. It's an extra token, if you like, going towards our full analysis. So it's something to take into consideration and bear in mind. Then the market rallies up past the medium-term moving average, sells back off. By this time, the short-term moving average is caught up. But again, confirmation is where it crosses here, that there's an actual signal on the way. It crosses the medium-term nicely on the 3rd of Feb. But again, where's the longer-term moving average? Nothing to be seen. Confirmation really is here. That's where confirmation is, and that's where it crosses the longer-term moving average. And again, here it crossed it by a certain amount, but then look what happened, it actually pulled back off. This is why a lot of people don't like trading gold, and why I would always have a 50 pip stop loss even on gold. It's confirmation here around 12.25, 12.30. Look where the market came back down to, back below towards 11.90. So it sold off 35, 40 pips. Again, you would be below here with 50 pip stop loss. So this is why you do have to be careful and time your entries correct. And this is what we go through on the training, the online training tutorials, and the masterclasses. It's not just about saying, oh, okay, yeah, it crossed it, right, oh yeah, it's crossed it now, it crossed it yesterday, or it crossed it 5 minutes ago. Yeah, let's get in, go. Stop loss, right, let's leave and forget. You can do that in a lot of instances, but to make sure you don't get stopped out more and it affects your strike rate and you lose 5 out of 10 trades or 6 out of 10 trades, you have to be aware of your timing on this and making sure that the allocation is correct, the risk reward, and also the gaps are perfect and price action is in your favor on the shorter term time frames that we spoke about the other day, what we spoke about earlier on in the previous video as well. So coming back from that, what happened then? It bottomed out again. Price just continued higher, like gold trades in waves anyway. Made a higher low from this region and from that region. Again, perfect trend line up. Market came back, another higher low, and moved on up towards that 1350 level. But again, really the confirmation was only when it crossed this yellow longer term moving average. You could have really got in maybe and caught some of this rally up anyway and actually been stopped out on your way down and just made a couple of pips. If you're in for the longer term trade of the beginning of the new trend, then yeah, you'd enter here 50 pip stop loss down this level. Just run through that one here for a specific entry on 12.35 before it actually rallied up to 12.60 there. So around entry of 12.35. Round about there and stop all the way down here, 11.85, right there for the stop loss. So this level here for the stop, right there. Entry here, obviously came back, tested, didn't get close to the stop loss level, and then rallied back higher. But again, that's if you're in for the longer term trend. You always have that 50-point stop. If you're only looking to trade it for a few days, then again you can have a tighter stop, but then you would have rode up this and made 20 pips on the upside anyway. Maybe raised your stop loss to within 10 pips and got stopped out on the way down on this neckline here, on this neckline, you'd have got stopped out on the way down and still made 10 pips. You would have given away back half of your profit, but again, catching this candle up, making that high and getting stopped out back down here before it's sold off back to entry point. So it's whichever way you look at it, but it all depends. For me, for these kind of longer term time charts, I like to stay in the trade and try and ride them up for as long as I possibly can. Days, multiple days, and even weeks and weeks and weeks. So for me, yeah, it's all depending on how long. This is really where you build your wealth in the longer term trades. But again, on a daily basis, by all means, bank 6, 7, 8, 10 pips, no problem at all. And again, backed up by your 15-minute charts and 5-minute charts and 30-minute charts. It has to complement what you're looking to do on the longer term charts. That's the most important. If it doesn't, then you haven't got that entry correct. Okay, guys, thank you very much. I'll see you all soon, and the very best.